everyone, and a very warm welcome to this discussion on the upcoming changes in inheritance tax, and in particular, the reduction in business property relief. My name is Peter Sterling, and I'm a relationship partner here at Cooper Parry. Most of my clients are family-owned businesses, some of which are into their third or fourth generations of ownership. And without doubt, the most common question I'm getting at the moment is, what do these changes mean for me? And what can I do to plan ahead and get ahead of the game? To discuss this, I'm joined by two experts, Sarah Worley and Sarah Axe, the two Sarahs, both of whom are partners in our private client tax team. Sarah, first question for you. The upcoming changes are huge. Can you summarise what for business owners they mean? Maybe starting off with what the current rules are and then how things are going to change going forward.
Okay, so in respect of the current rules, if you own shares in a trading company, then you should qualify for 100% business property relief. So if you were to die holding the shares, then there will be no inheritance tax on the value of those shares on your death. The new rules post April 2026 restrict that relief. So you only get 100% on the first million. The balance over $1 million is then subject to an effective tax rate of 20%. So if I've got company shares, they're worth, say, 30 million. If I die after April 2026, the inheritance tax liability will be £5.8 million compared to nil now. So it's just huge, the increase.
Wow, Sarah, that's a huge amount of tax and a big difference. I turn to you, Sarah. How are businesses, when is the tax payable? And how are businesses expected to fund that liability, a liability which to date they've simply not had to think about?
So the standard payment date is 6 months after the chargeable event. Most commonly that will be on the death of a shareholder. Now, the government have given the ability to pay that tax over 10 annual instalments on an interest-free basis. So that is a little bit of a reprieve there. In terms of how they will fund that liability, though, it depends on the other assets that are in the estate that the deceased holds. So it might be that there are already some liquid assets available which can be easily used to pay that liability. If, however, the deceased's main asset is the shares, then their beneficiaries are really going to think about how they fund that. And it might be that they need to extract money from the company, and that will be maybe as a dividend, which would be subject to income tax liabilities. So the real tax cost of these inheritance tax charges is even more significant if you need to pay income tax to extract funds to pay it. Even as a worst case scenario is the position that the recipients of those shares need to consider a sale of the business.
So in practical terms, if in the deceased's estate, the main asset was the shares in these businesses, and let's use Sarah's example, a liability of 5.8 million, you might be looking to sell a substantial shareholding in that company to fund the tax liability. And as we all know, selling shares in a private company, especially if it's a minority stake, is not without its own problems. So I think that's a big potential practical issue for business owners to think about going forward.
Exactly. It's not just about the tax that's payable, it's about how the problem that the beneficiaries will have to deal with in the future, potentially.
Thank you. Is there time, Sarah, another follow-on question for yourself, to plan before April 2026 when these new rules come in? As a business owner, what should I be thinking about now?
There's definitely still time to plan, and the start point really should be to determine whether or not the business interests that you hold do qualify for the BPR relief, and if that's on an unrestricted basis or not. If there are restrictions to the relief, that there could be some easy fixes there that professionals can guide you through. The next step really is to determine what is the change in your inheritance tax exposure. So when these rules come in from April 26, what is that inheritance tax liability that would be triggered if you don't take any action. And this is also where, a valuation would come in to help you determine the value of your shares and that inheritance tax number.
Because in my experience, most private business owners don't have a real understanding of what their value is here for tax purposes. There's a commercial valuation and there's a tax valuation, which we're talking about here, that takes into account minority interest discounts, lack of marketability discounts. It's important to get that professional valuation.
It is that, because some business owners may only have £1 million of value, and that will be covered by the allowance. So it's about understanding what your exposure is under the new rules. Is there a change or is there not? And once you know that, that will usually help someone to decide whether or not they want to start thinking about what their lifetime gifting strategy is.
Okay. When you say lifetime gifting strategy, give me some examples. What are you thinking about that?
So there's lots of different options to consider. Simple gifts from one individual to another of shares. Now, we've got to be careful there to make sure that we have relief from any capital gains tax charges that could be triggered. There's also the opportunity to transfer shares or other assets into a trust. And then, we can look at more bespoke solutions like family investment companies, which in themselves don't necessarily give you an inheritance tax saving, but they are very friendly vehicles to allow you to plan efficiently for inheritance tax. Some people might not be ready to give away capital, and then we can look at strategies that essentially divert growth in the value of their assets to either the younger generation or the trust without an actual transfer of wealth. So there's lots of different options to consider there.
They're the sort of the growth or freezer shares you're talking about there.
Yes,
yeah, okay.
Yes. So essentially you would freeze the shares of maybe your kind of founder shareholders and give growth rights to shares held by younger generations.
And to keep that growth out of your estate.
Exactly. And this is an area where the valuation is really key.
Sarah, apologies, I'm firing all my early questions to you. You mentioned trusts there. Can you explain to us what a trust is at a high level and how trusts have a role to play in inheritance tax planning?
A trust is a vehicle that people will use if they're comfortable to give capital away. They're comfortable for that to come out of their estate, but maybe they aren't comfortable with it going to their beneficiaries, say their children, directly and going into their children's estate and their children's ownership. So we would use a trust to give the transferors a level of control over those assets whilst they remain in that trust structure. So how that would work from an inheritance tax perspective is that an individual would transfer value to a trust. If that value doesn't qualify for BPR, there is a limit of $325,000. Any value over that would create a lifetime inheritance tax charge of 20%. If, however, we are transferring BPR qualifying assets under the current rules, so pre-6 April 26, you can transfer any BPR assets on an unlimited basis. So you could put £20 million worth of assets into trust and there would be no charge because you've got that uncapped relief. And as long as the transferor survives for 7 years from the date that they transfer that value into trust, it will then be fully out of their estate. A benefit from a trust perspective is that the value doesn't sit in anybody else's estate. It is in the trust. The trust does have its own inheritance tax regime.
Thanks. So trusts do have an important part to play, and I think, Sarah, you're going to talk a bit more about that later on in the discussion. Sarah, and I think this question probably neatly follows on from what Sarah's just been talking to us about in trusts. If I'm a business owner thinking of selling my business in the medium term, let's say the next 5 years, what should I be thinking of? Do these new rules have any impact on me at all?
Yeah, I think you'd sort of think no, because you're going to sell the shares and therefore business property relief won't apply at all. So why should I be concerned about them? Well, if I just sort of explain first the planning that we often do with clients before a transaction, under the current rules, and then explain the impact of the new rules on that. So under the current rules, again, we'll go back to my example. We've got a business worth 30 million. I want to put aside 10 million of that for my children, grandchildren, and future great-grandchildren, and so on. But I want to do that in a protected environment, as Sarah said. So I'll use a trust. So before the deal happens, I would set up a trust, and I would transfer in £10 million worth of shares into this trust. After 7 years, that's outside my estate, but I can transfer the shares in because they qualify for 100% business property relief. So Sarah said the amount is unlimited as to how much they can go into trust if they qualify for 100% business property relief. So I put my £10 million worth of shares into a trust. The deal happens, the trust ends up with £10 million worth of cash, and that's going to fund, it's effectively going to be my legacy for future generations. Post April 2026, that is not possible. The unlimited bit disappears. So post April 2026, the maximum I can put into a trust is 1.65 million. So dramatically reduced. What that means is if you are thinking of selling in the next 5 years, say, you need to be thinking about putting those shares into trust before April 26 while you still got that unlimited relief. So while you still got that 100% relief. So definitely, if you're thinking of selling, get some professional advice and think about putting shares into trust before April.
Okay. So a huge planning point there.
Huge planning
And what
point.
happens going forward if you put in more than 1.65 million?
Well, as Sarah said, you end up with a lifetime
A lifetime.
inheritance tax charge of 20%.
So a lot of people
So-
think inheritance tax is only payable on death.
Yeah,
In fact, you can sleepwalk into it with lifetime gifts.
exactly.
A couple of questions on dates, if I may. The proposed changes to inheritance tax were announced in the budget in October 2024, with most of the impact being coming into force in April 2026. Does that mean if I gifted shares before October 24, either directly or into trust, I've escaped the impact of these new rules?
Yeah, so I think in most cases you will, because if you've made the transfer in and you qualify for 100% business property relief, and that was done before budget day, even if you were to die in that 7-year period, provided either the trustees or the individual still held those shares, you would still get the unlimited 100% business property relief, so still under the old rules.
Okay. And if I'd set up a trust before October 2024, Sarah mentioned that trusts have their own tax rules. So the gift of shares into trust before October 2024, are they completely unaffected by the new rules?
No, so they will be caught by the new rules, but not until the first 10-year anniversary. So they should, in theory, get the £1 million allowance as an individual would. But there are sort of so many rules about trusts. So I think if you're sitting here as a trustee, you ought to be taking advice, because they may be planning to do before the 10-year anniversary. You may want to advance some of the shares out to beneficiaries, for example, understanding your exposure, which we talked about, and also thinking about how the trust funds the inheritance tax liability at that 10-year anniversary. Because if it only owns trading company shares, it has no cash. And the only way to get cash would be to have a dividend on which it'll pay income tax to pay the inheritance tax, which is never great. So it's sort of planning in advance.
Okay, so again, there's some hidden effects there. I think most trustees, and I'll be honest, myself included, thought that if I'd got shares into a trust before October 2024, these new rules would have no impact on me at all. But as you've said, maybe the first time people will recognise this is when the 10-year charge comes up and there is planning to be done and thought to be applied to that topic.
Yeah.
Sarah, second question on dates. We just touched on what would happen in respect of gifts made before budget day October 2024. Just to drive this point home and to follow it on. I'm sitting here today. The new rules come in April 2026. If I was to make a gift now, before the new rules come into play, am I outside the effect of the new rules?
Not necessarily. So if you made the gift now, you've got 100% relief, so you can transfer to an individual or to a trust. But if you were to die within 7 years and after April 2026, that gift then is measured under the new rules. So it's brought back into your estate and calculated, so you'll get the £1 million allowance and then the effective 20% rate of tax. But it does get any growth on the gift. It freezes the value of the gift because the gift is now. And I think any action now is better than doing nothing and then trying to do something earlier. And the sooner you start that 7-year clock, the better.
Okay. And the sliding scale that we're on at the moment, the tapering down of the inheritance tax rates for deaths between 3 and 7 years, how's that impacted?
Yeah, so at the moment, as we understand it, you would still benefit from taper relief if it ended up that there was tax on a gift. But again, sort of whether that will change in the future or in the autumn budget, who knows? But at the moment, as we understand, that would still apply.
Okay, thanks. There's been a lot of opposition to these changes to inheritance tax in the press, business lobby groups and the farmers in particular. We've been focusing on business property relief, but of course agricultural property relief that affects the farmers is very much the same thing. We're expecting some final announcements in the budget in the autumn statement. Are you expecting any changes to the proposals?
My view would be that it's unlikely there's going to be a big U-turn on these BPR changes. We've had draft legislation just 6 weeks or so ago, so I think if they were planning to do some real big changes, they wouldn't have released that in advance of the budget. I think what we are expecting, however, are potentially some further restrictions on inheritance tax and the opportunities for lifetime gifting. So I think that's one of the reasons why we're probably encouraging people to take some advice sooner rather than later, with a view to maybe making transfers before budget day.
So you're talking here, Sarah, about the press speculation that the 7-year gifting limit may be extended, or even the introduction of a possible lifetime allowance for people to make gifts to the next generation or indeed whoever.
Exactly, yes. At the moment, it is speculation, and who knows what might come up, but I think that's our concern at the moment.
Okay, thank you. Sarah, thank you for that. You've covered a hugely complex area in a very succinct manner, so thank you. Sarah, final question. I'm sat here as a business owner. Give me the key action points, the key calls to action arising from this discussion.
My suggestions would be for people to understand their exposure, know what their options are, and take professional advice.
Thank you. Thank you.